under Canadian federal tax law, there is a provision that can shelter well over $1 million in capital gains tax on the sale of qualifying small business shares. Over $1 million sheltered from tax. Most Albertan owners have heard about this, although very few understand it and don't understand if they actually qualify or how it works. And even fewer have taken the legal steps to make sure their business is ready for it. In this episode, I am going to talk to you about this provision and what you need to do in advance now to make sure your business qualifies in the future, because the window closes quicker than most people think. I'm Chad Graham. I'm a corporate lawyer, and in this episode 3 of Built to Sold, I am going to walk you through this, but it's important to understand that the provision I'm describing, the Lifetime Capital Gains Exemption, is primarily a tax matter. That means the analysis of whether your corporation qualifies and the quantification of the specific benefit to you belongs to a qualified CPA, ideally one with experience in business sales and corporate reorganizations. My role as your lawyer is the corporate documentation of your business, including your minute book, your share register, your articles, and then dealing with the structural reorganization transactions that may be needed and that your CPA may recommend. We work together, and neither of us does this alone. With that framing in mind, let me walk you through the big picture. When you sell shares in a corporation and realize a capital gain, you normally pay taxes on that gain. The gain is included in your income. You pay at your marginal rate on the taxable portion. The Lifetime Capital Gains Exemption, or LCGE, is meant to be a benefit to small business owners. They are not eligible for RRSPs and other employee-style retirement plans. So their business becomes their retirement plan, and this makes something like the equivalent to an RRSP. This provision under the Federal Tax Act allows the eligible individual shareholder to shelter their capital gains up to a cumulative lifetime limit from tax. This limit is indexed and changes every year, so speak to your CPA about where it is today at the day of your sale, but today it is well over $1 million. What does this mean in practice? If you sell your qualifying shares and you realize a capital gain of, say, $800,000, and you've not previously used your exemption, you may pay essentially zero taxes on that transaction. And that's no rounding error. If you fail to be ready to do this and you have to pay taxes on it, hundreds of thousands can be lost. Here is the catch. Your corporation must qualify as a qualified small business corporation. And many corporations as they exist today do not. At least not without advanced planning. Let me walk you through the 3 critical tests and how we can deal with them. Your CPA will do the precise analysis of your corporation. Again, this is big picture thinking. Test 1 is the CCPC test. Your corporation must be a Canadian controlled private corporation, a CCPC, at the time of sale. Now, for most Alberta corporations, pretty much automatic. But if you have foreign investors or a more complex ownership structure, or foreign buyers, owners own some of the company, then this needs to be sorted. Test 2 is the 50% test at the time of sale. That means at the moment of disposition, more than 50% of the fair market value of the corporation's total assets must be attributable to assets used principally in the active business carried out primarily in Canada. Active business assets are things like equipment and accounts receivable and goodwill and working capital that is actually being used in the operations of the business. These contrast with passive assets, things like excess cash sitting in a GIC, investments held by the corporation, and real property that is not being used in the business. Here's where a lot of Alberta business owners run into a problem. Your company has been running profitably for 15 plus years. After-tax profits have been accumulating. The cash is sitting in a corporate bank account or invested in a portfolio. That cash is a passive asset. If these passive assets represent more than 50% of the corporation's total value at the time of sale, You fail the test, and the exemption's gone. Test 3, the 90% test, looking back over 24 months. That's 2 years. Throughout the 24 months immediately preceding your sale, your disposition, more than 90% of the fair market value of the corporation assets must have been principally used in active business. And during this period, the shares can only have been owned by you or a related person. This is one of the catches one of the things that catches many people off guard. Even if your company looks clean today, if there was a significant period in the last 2 years when the passive assets were high, you may still have a problem. This is exactly why planning needs to happen now, well in advance, not the week before you call a broker or are called by one. To get ready, what we do is a process called purification. Purification is the process of restructuring the corporation before a sale to remove those passive assets, so that the 50 and 90% tests are satisfied when the time comes. The simplest strategy for a business with accumulated cash is to dividend it out. This reduces the passive assets on the balance sheet. And your CPA can talk to you about the tax implications of any distribution. Your lawyer will document the corporate resolutions authorizing it. It's clean and relatively simple. Where it gets more complex is where the passive assets are not easily distributed. For example, the corporation holds real estate that isn't used in the business, or when the corporation has an investment portfolio that would trigger significant taxes if liquidated. In those situations, your CPA may recommend a more structured reorganization. The most sophisticated version involves a transaction called a butterfly. Here, a corporate-level restructuring happens under certain sections of the Income Tax Act, where you can transfer private assets, which remain with the seller, through a holding company, a related person. Butterfly transactions are very complex. They require an experienced lawyer and an experienced CPA working closely together. They also take time to implement properly. This leads me to the most important practical point of this episode. Start early. The 90% test look back means the structural changes need to be made 24 months before a potential sale takes effect. Ideally, purification and corporate cleanup should be something that you're regularly considering. Then there is this is what standard corporate cleanup would look like. Alongside this tax-driven purification work, the parallel legal housekeeping that can be done now, and every seller needs to complete. First, we need to look at your minute book. The Business Corporation Act requires you to maintain a share register, the minutes of directors and shareholders meetings, register of directors and officers, and a copy of your articles and bylaws. This corporate record is called a minute book. In my practice, I can't tell you how many minute books I have seen that were basically the documents when the company was set up and then nothing else added to it. Annual resolutions are missing. Share transfers that happened years ago were never documented. A director who left in, 2018 is still on the register. This creates real problems because a buyer's lawyer will review that minute book as part of due diligence. Gaps in the record generate questions. Questions generate negotiations. Negotiations generate delays. And a buyer with leverage will use that leverage. A clean minute book is not glamorous work, but it matters. Second, the articles of incorporation. We need to confirm the share structure and the articles match the actual share structure of the corporation. If shares have been issued, redeemed, or transferred in ways that aren't reflected in the articles, this needs to be reconciled. If the CPA is going to recommend one of these more complex transactions, you must have a complex set of articles. Third, shareholders agreements, USAs, unanimous shareholders agreements. If you don't have one, you should. And if you do have one, it almost certainly contains provisions that affect how and to whom shares can be sold. Rights of first refusal, for example, can give co-shareholders the right to match any offer before you sell to a third party. Drag-along rights allow a majority shareholder to force majority shareholders to sell on the same terms they get. Consent provisions may require approval before transactions can happen. All these different provisions need to be understood and addressed before you approach or are approached by a broker or buyer. Discovering this right of first refusal after you've signed an LOI, well, that can be embarrassing. Fourth, outstanding loans and related party transactions. Shareholder loans, directors' loans, and related third-party transactions that sit on the balance sheet need to be identified and resolved before a sale. These are the kind of items that generate pointed questions in due diligence. And buyers will use it to negotiate price adjustments or indemnities. Finally, PPSA registrations. The Personal Property Securities Act allows for registrations on security against security interests in the corporation, assets that it holds. These need to be identified and, where appropriate, discharged before closing. Buyer will not close on a purchase with undisclosed security interests outstanding. Let's put it all together and think about the timeline then. Let me give you some real practical pointers. If you're planning to sell, say in the next 2 to 3 years, call your CPA now. Have an analysis done. Understand where you stand on the passive assets test. Begin any purification work that's needed. And call your corporate lawyer to do a full minute book review and cleanup. But what if you're planning to sell in the next 12 months? Is it too late altogether? No. No, the window for meaningful tax-driven restructuring is narrow, but it may not be closed. Get both advisors involved immediately. There may still be steps that can be taken. If you're already in active discussions with a buyer, the priority will shift from making sure the documentation is in order, to making sure the documentation is in order and that the existing structure is represented accurately. Your lawyer's job becomes managing that due diligence process and protecting your position in the purchase agreement. We'll cover that more in future episodes. So there it is. The Lifetime Capital Gains Exemption is real, it's significant, and it's potentially available to you. But it requires advanced planning. The corporate cleanup is manageable, but it takes time to do it properly. The single most valuable thing you can do today, if you haven't done it already, is pick up the phone and have a conversation with your CPA about where the corporation stands on the QSBC tests. Then have a conversation with your corporate lawyer about the state of your minute book and your corporate structure. If you're in Alberta and you want a legal review, visit chadgrahamlaw.com to book a consultation. We'll go through your corporate records, identify any gaps, and give you a clear picture of what needs to happen to make sure everything is in order. In episode 4, I'm going to talk a little more about how buyers tend to actually calculate what your business is worth and that valuation framework that you need to understand before you ever sit across from a buyer. I'm Chad Graham. Let's get your house in order.